now we're going to bring on Mr. Michael Gayed. Michael, how are you? The author of the Lead Lag Report. And wait, tell me about this, Michael. You're a portfolio manager at Tidal Financial Group. Tell us a little bit about that for a moment.
Yeah, we actually just renamed our firm name from Toroso to Tidal Financial Group. So I'm the portfolio manager of the ATAC fund family, the ATAX, HACX mutual fund, the RORO, RORO ETF, as well as the JOJO bond ETF. And I put out quite a bit of research, as you guys know, through Twitter, through the Lead Lag Report, sometimes loud, sometimes contrarian, often in doubt, believe it or not. But that's actually probably the best thing to do when you're dealing with the unknowable tomorrow.
No kidding, and especially in this environment. Let's take a moment and speak a little bit about the current environment. One of the things I love about the Lead Lag Report and what you do there, and what you've done for years, is looking at how lumber reacts to certain markets to give you an insight of how you feel about the current market environment. So tell us now. I mean, obviously we're on a Friday. We're seeing a nice bounce. S&P's, above 3,700, thank goodness. We're seeing a recovery in risk. Did you see this coming?
Well, I think it's important to distinguish between seeing something coming and then and identifying the conditions under which something is likely to happen.
Yeah.
Right. I always go back to this point that people focus too much on the call when you should focus on the conditions that favor the probabilities that favor the outcome. Right. Conditions are first and foremost the number one thing. Be the weatherman, not the person that is trying to figure out the exact mile marker something happens. Right? That's the mindset. Let's take a step back. Look, as much as I'm loud on Twitter and as much as I put out all this research, at the end of the day, I'm purely quant-based and rules-based. My funds are purely rules-based, and I've been very public in saying that this year has been hell. I've been saying that since March, April, because I saw the treasuries, the classic risk-off safe haven, we're failing to act as the risk-off safe haven. And when you're rules-based and managing to prospectus, you can't do anything about that. So I could see that something was breaking, but I couldn't change the way the strategies are inherently run, because that's what I created the funds to do, to be into treasuries when you're in these risk-off periods. The irony this year is that the signals that my funds use have been largely risk-off and correct from that perspective, meaning utilities have been strong throughout the entire year. Going back to the 2014 Dow Award paper, when utilities are strong, that's a risk-off signal. JOJO was in treasuries as a result of that. Usually works, didn't work this year. Lumber to gold has been weak the bulk of the year, risk-off, telling you that housing is about to slow down. Guess what? That's been right too. Treasuries, as the expression, the risk-off play was not. First time in history that you have this kind of interaction in the volatility sequence. Now, all that's abnormal. Treasuries going down more than stocks in a big drawdown for stocks. But let's take it a step further. One thing is to say that stocks and bonds both lose money. Another thing is to say how they lose money. So you look at the number of weeks that the S&P 500 has lost money this year. You're at 64% of the year using weekly data. Stocks have been in the red. That hasn't happened since 1931. Okay, well, now let's look at treasuries. 74% of the year, treasuries have lost money using weekly data. First time ever in history. So here I am rotating funds using weekly signals across equities and treasuries, and damn if I do, damn if I don't, because the odds are immediately against me. Now, here's the thing about this environment. People have been conditioned because of this past behavior to think that it will continue. You can't blame them. Recency bias is the number one bias on Twitter. I see lumber strengthening. That's a sign of risk on. I see utilities collapsing relative to equities the last 3 weeks. That's a sign of risk on. I see the S&P actually holding around levels and small caps holding around these levels while treasuries are still collapsing, which is really interesting. I look at all that, and then I see the qualitative responses I get from people who have never read my research, who are unable to look beyond the sample size of this year in terms of the performance of my funds, thinking that I don't know what I'm talking about because I've gone through a nasty drawdown that I couldn't do anything about because they're designed to be treasuries, the pinned tweet. And there is almost a degree of vitriolic hatred around the idea that maybe you could have an enormous rip your face off, melt up type of rally because the conditions are there. And I always go back to this point. Opportunity always exists when the crowd thinks it knows an unknowable future. I have been the loudest on Twitter saying this has been hell, that what's happening in the bond market is beyond serious. But because it's so serious, it cannot last. Everyone's talking about a Fed pivot. Let me tell you something. You got plenty of other central banks that could pivot. Those that are in power will stay in power. How are they going to stay in power? By saving the system. The only way you save the system is by stopping this insane volatility in bonds. That's what I think people are not understanding. You can't have bond yields rising at the pace they've been rising without 30-year mortgage rates in a month at this rate being at 20%. The system stops if the bond market volatility doesn't stop. Because of that, you have to bet that it's going to be the other direction, that it's not going to be the end of the world, that things will end up resulting in a reversal when just as everybody's so convinced that it's impossible to rally ever again.
Do you think we're there yet? Or do you think there's more pain to come? Because, and I actually have to stop for a second. I will also want to ask you about conditions. Do you think the conditions are right from a macro standpoint when the Fed is still obviously hell-bent on raising rates to maybe 5%, wherever they feel the terminal rate's going to be? Are the conditions right for that rip your face off rally?
Okay, so let's go back to the Fed doesn't own the bond market. The bond market owns the Fed. Full stop. Okay, these numbers are too big, right? I think the conditions are there here and now. Aside from all this other stuff in terms of leading indicators, lumber, gold, utilities, all this stuff now confirming risk on, and sentiment being so dark, no different than March of 2020 when everyone thought it was the end of the world, in which case you might as well YOLO into stocks because it won't matter otherwise. It's kind of like the argument that if you have nuclear war, you buy stocks because you'll be dead anyway, right? You might as well take the chance. I think we're at that kind of a moment for the financial system because, again, yields cannot be spiking in this way without there being something cataclysmic. Okay, so I think that we are at this sort of do or die moment. Okay, where you're probably going to get multiple central banks trying to intervene with maybe some dollar swap line usage. We're starting to see some of that, by the way. Okay, all the stuff that you typically see in terms of a pivot is starting to happen on the periphery. It's just not being talked about because people feel like they need to hear it from the Fed.
Yeah.
Okay? Now, I don't believe that the ultimate low is in, and this is a very big, important point. Bear markets are notorious for making fools of bulls and bears, meaning that you look at any historical bear market, you better believe there are 20, 30% rallies before making new lows. This is about the path. The damage that the bond market has done is there. It's not going to go away. We're going to be in likely a deep recession. None of this is going to change the economic trajectory. But to the extent that you have a classic bear market rally, which would shock everybody, and to the extent that this path behavior has conditioned people to think that stocks can only go lower, right? That's like a perfect contrarian setup for a trade. I'm not arguing necessarily that we're out of the woods. No, this is going to be a process. But when everybody is so certain of a particular thought or a particular thesis, it's probably going to be most prudent to think differently. And I made this point too a little bit earlier on Twitter. It's like if you were to look at long duration treasuries, TLT, the chart, using weekly data, and just looked at that chart, ex dividend. If you looked at that and said and thought that was a stock, you'd say that what's happening in treasuries is capitulation. If you cut off the tail risk of yield on the long end spiking further, if you cut off the tail risk of treasuries being the risk to stocks, right? Instead of being the beneficiary of volatility in stocks, they are the source of it this time. If you cut off that tail risk, you better believe you can have an enormous run very suddenly.
So, what do you think as far as? I know this has been a tough environment for a lot of people because of the traditional, splits between stocks and bonds. What do you think caused it this year? Would you say it was the root cause?
So I disagree wholeheartedly with anybody and everybody that says that this is because the Fed hiked rates. The Treasury drawdown began in August of 2020. It was around August of 2020. That's before the Fed started hiking rates. I disagree entirely with the notion that the dollar is strong because of interest rate differentials. The dollar bottomed in April of 2021, long before the Fed started hiking rates. So I don't know. Look, obviously there's a component of inflation in this. Obviously there's a component of the Fed, but it cannot be fully explained away by the Fed. And keep in mind, the Fed controls the short end. The Fed controls the short end. There are plenty of instances where the Fed hikes the short end, and guess what? Long duration yields do what they're supposed to do when you're in high volatility periods, meaning they fall, or at least they act stable instead of the garbage of this year. So, look, I get it. Everyone always wants to find a reason. There's a degree of this that I don't think we can find a true reason for. I don't think it's, again, fully because of the Fed, because the timelines don't match up. But having said that, when you're in an environment where you have $300 trillion of global debt, and you're in an environment where government debt is acting more volatile than penny stocks, you have bigger things to worry about than the value of your portfolio. That's my entire point here. I am so bearish on that dynamic that it can't possibly play out. Just like in the midst of the lockdown with COVID in March of 2020, I was on Bloomberg and I said, listen, if it's the end of the world, you might as well buy guns and butter. Your portfolio doesn't matter, so you might as well take the chance. We're at that moment now.
So it sounds like to me, this is one of the things that maybe keeps you up at night. Could you elaborate on that key moment that you think we might be at?
It would be that bond stabilized, meaning that we could have seen, for all I know, with hindsight, the 30-year Treasury yield top today.
Yeah.
Okay, because it was spiking and then came back in. And again, it kind of makes sense because if you keep going at this pace, I keep going back to it's a joke, but not a joke. If the 30-year yield keeps rising at the pace we've been seeing, you're going to see in a month and a half, 30-year mortgage rates at 20%. The system doesn't work that way. So this is what I'm trying to explain. It's like there's multiple ways of thinking about tail risk. This is a financial system tail risk, unlike anything we've ever seen. Okay, you saw it with gilts. Okay, and if you think that it happens to treasuries and that's normal and that's going to help your pay off your put and your short position, good luck, because I'm going to argue to you the entire financial system fails under that. I don't believe that's going to be the case. I believe that there's going to be some kind of cutting off of that extreme financial tail risk that bonds now are presenting, at least for a moment in time. And I keep going back to path matters more than prediction. If everyone's convinced, again, that it's the end of the world, it's probably not going to be the end of the world.
Right. That's what everybody's the doom and gloomer right now. So, we may have a minute or two continued. And if anybody has any questions for Michael, please bring them. That'd be great. Because we're waiting on our next guest right now. He should be here any moment now. But I want to ask you just a couple of things. As far as like opportunities in the market, real time right now, what are you thinking at this moment, Mr. Gayed? What's he thinking in the markets?
Okay, so a couple things. First of all, part of this theory is also contingent upon the idea that the dollar breaks down. And the dollar has been having a hard time trying to break through. So let's say the dollar were to depreciate, which would take the edge off the sovereign debt crisis risk that, by the way, I've been saying for many months the dollar might be anticipating. That probably means international has a run. I'll take it a step further. It's not just international, though. If bond yield volatility subsides, you'd expect small cap companies, which are highly levered, all the junk stocks, to suddenly have an enormous run because you reduce the potential for default risk, at least perception-wise, for a moment in time. And by the way, that argument that junk rallies the hardest is what happened in 2009. It's what happened in March of 2009. It's what happened in 2020, right? What I'm arguing is totally consistent with history. If you take off the end of the world risk, which is ongoing bond market volatility, the areas that probably run the hardest are not going to be large cap names. It's going to be those junk areas which got utterly destroyed since the bear market started in February of 2021. Again, for a trade.
Okay, well, there's a question from one of our viewers. Is there a chance for the market sentiment to change and gold to start moving up with higher inflation numbers instead of continuing the downtrend? Do you have any opinions on gold?
Yeah, I mean, maybe. I mean, the thing is, gold doesn't really correlate too highly consistently against currency, although if I'm right that the dollar may have had its peak and that you start seeing some kind of depreciation, at the margin, that might help benefit gold. But I think, look, if you really want to get the most bang for your buck, again, for a trade, you probably want to go into the biggest laggards. This is the thing about mean reversion. When you have everybody betting one way, when you have sentiment being so dark, and by the way, when you're lagging the market, what's the best thing somebody that's lagging the market can do to play mean reversion? To play the bigger laggards, right? In other words, play the things which are down even more than what your original strategy is designed to take advantage of, right? So gold could run maybe, for during this trade, but I think if you're going to really try to play a cutting off of the financial system tail risk that bond volatility, I believe, is causing, you want to go into the areas which everybody left for dead.
That's some great advice. Well, Michael, before we let you go, like I said, I'm a big fan of the Lead Lag Report. Love following you on Twitter. How do people find out more about you and what you do, not only at the Lead Lag Report, but also at Tidal Financial?
Yeah, I appreciate it. And you know, Tidal also launches ETFs. We do a lot of things beyond just my funds, obviously. But at Lead Lag Report on Twitter, or leadlagreport.com. Listen, I do my best to communicate openly and try and counter people's thinking with real data. And all I'm trying to do is give voice to that data. And listen, I get the cynicism, the skepticism. I've gone through complete hell in my funds this year, and I said it from day one. But hell ends at some point.
It's a great point. That is a great point. But since you're in the Windy City, maybe not until spring. I'm just kidding.
Markets are forward looking, so spring comes now.
There you go. Hey, Michael, it's always a pleasure speaking with you. I love getting these opportunities to have one-on-ones with you. I hope you have a great day, and thank you for spending your time with us generously on Friday with the Trader Summit community.
I appreciate it, guys.